Hello everyone. In this video, I'm going to use some fundamental finance concepts to help you reflect on certain types of financing schemes or payment plans that at first glance may seem as if they're interest-free, but they really aren't. Let me try and illustrate using a comprehensive example. So let's suppose you go to a bank and you say, look, I need a $540,000 loan. And the bank says, okay, the annual interest rate that we're going to charge you on this loan is 4.2256%. It's a weird number, but bear with me. Let's suppose the bank further says that, look, we're going to ask you to make monthly constant payments, and the interest rate is being compounded monthly. And finally, the term of the loan is 5 years, which means that you'll need to make these payments over the next 60 months. And you're going to have to make these payments at the end of each month, which means that if you try to depict the situation on a timeline, then what it looks like is that you are here at time period 0. Here's month 1, month 2. Here's 60 months. And what you're being told is that, look, you're getting a $540,000 loan over here, and you have to make constant payments of, say, C here, and then another C here, so all the way out till 60 months. Now, if somebody asks you, what is this monthly payment you would need to make? That, as it turns out, is a fairly simple exercise in loan amortization, and so I have a separate video on that, but it turns out that this amount will come out to about $10,000. So in other words, if you pay $10,000 at the end of each month for the next 60 months, you will not only retire the initial principal amount or the loan amount, you will also pay off the interest of 4.2256% that you're being charged on this loan. Okay, so that's a very simple example of loan amortization. What I want you to do now is bear this at the back of your mind and look at a very different example. So now let's suppose that you're interested in buying a house, and let's suppose the cost of the house is $600,000. Now, you don't have $600,000, but fortunately, the seller or the entity that is selling you this house says, hey, don't worry about it. We have a payment plan. So you can pay us $10,000 every month for the next 5 years, which is basically 60 months. In other words, you don't have to pay us $600,000 right away. You can just spread it out over the next 60 months, right? So if it's $10,000 every month for the next 60 months, that's basically $600,000, which if you try to depict on a timeline, basically looks like this. You're paying $10,000 and another $10,000 right here at the end of month 2. And this will go on for 60 months, and you'll make your final payment of $10,000. Looks great. But let's suppose, and here's the twist, let's suppose that right here in the footnotes it says, oh, by the way, there's a 10% discount if you make a full cash payment. Now that is interesting, because if you look at the way the payment plan is structured, at first glance, it may seem as if it's just $600,000 that is being spread out over 60 months. But if there is a 10% discount on full cash payment, what that means is that if you had the money, then here at time period 0, you would have just paid $540,000 to buy the house, right? Which is 10% less. Right? It's $60,000 less than the price that is stated over here. What I'm trying to say is this. If you had the money, which is $540,000, you could have used that to purchase the house. In other words, the house is really for $540,000, but because most people don't have these kind of funds lying around, they enter into a payment plan where they're really paying $10,000 every month for the next 60 months. Now, this may ring a bell because if you actually take a look at this timeline and then the timeline that you had before, they are identical. In this example, you were also borrowing $540,000. You were making a payment of $10,000 at the end of each month. And the reason why you were doing that here is because you were trying to take care of this 4.2256% APR that you were being charged on this loan. What I'm trying to say to you is this. Even though when you look at this payment plan this way, even though it might seem that you're not paying any interest, The fact of the matter is that if there is a 10% upfront discount on full cash payment, what that really means is the house is for a lower amount that is stated over here, which means that effectively you are borrowing this amount today from the entity that is selling it and then making these payments towards this loan. In other words, put differently, if you went to the seller and said, look, here's $540,000, you'd get the house. Because you don't have this, the seller simply says, oh, just pay me $10,000 every month for the next 60 months. So it's either this or you pay this upfront. In other words, you are basically paying an interest of 4.2256% on this loan. So let me give you an example of such a payment plan at work. The example that I have for you is actually from Pakistan. So there's a housing scheme in Pakistan called Safari Garden, and on July 3rd, 2019, when I pulled data on these payment plans that Safari Garden is offering, it's basically saying that, look, we are offering these residential and commercial plots for people to purchase. They're of different sizes. So in Pakistan, plots are measured in marlas. And so if you're somebody who is interested in buying like a 10 marlas residential plot in Safari Garden, they're saying, look, we have a payment plan for you where you can get it for a total of 3.4 million rupees. And the way the payment plan is structured is that first you will need to make an advance payment. This is basically a down payment, which is 680,000 rupees. If you do the math, this actually comes out to exactly 20% of this total amount. So first you'll need to make an advance payment. Then after that, the payment plan calls for 48 monthly installments of 50,000 rupees. So 50,000 over the next 48 months or 4 years, which if you do the math comes out to a total of 2.4 million rupees. And then once that is done, then there is still a remainder balance of 320,000 rupees that would need to be paid upon possession. Now this is a little bit technical and I don't want to make this too technical over here. Let's suppose that anybody who is entering into this payment plan will possess the property at the end of 4 years. Technically, they can do it sooner, but again, I want to abstract away from that. So what this means is that you would first make a payment of 680,000 as a down payment. You would pay a total of 2.4 million rupees over the next 48 months. And in the last month, we are assuming that that is when you will possess the property, in which case in the last month you will make a payment of 50,000 rupees and then an additional 320,000 rupees. What I'm saying to you is that if you take this down payment, column B, if you take this column F, which is the total amount of monthly installments that you will make, and finally this last amount, which is the payment upon possession, these three basically add up to the 3.4 million that you're seeing over here. So this is how this 3.4 million will be spread out over time. This is interesting. What is even more interesting and is something that is not immediately apparent to most people is that right here in the footnotes, it then says, look, there is a 10% discount that is available on full cash payment. Now, what that means is that if you have the funds, then this property doesn't cost 3.4 million rupees. It actually only costs you 90% of that. So if you do 90% of the 3.4 million rupees, that actually comes out to 3.06 million rupees. And so really, if you had the funds, you would only need this amount to buy this property. The problem is that most people don't have these kind of funds, in which case they have to pay 3.4 million over time instead. And what I'm saying to you is that as long as there is a discount of this sort in place, basically this is as if you are borrowing 3.06 billion and then over time paying 3.4 million rupees, which means that you're paying some interest on this amount that you are borrowing. And so what I want to do now is sort of walk you through how much interest you're effectively paying on these quote-unquote loans. So what I've done over here is practically copied all the information that was in the payment plan and pasted it in Excel. So for this 10 marlas residential plot, the total price was shown as 3.4 million rupees, and we know that this was going to be paid out first as a 680,000 rupee down payment. then would involve paying 50,000 rupees every month for the next 48 months, and then finally would require a payment of 320,000 rupees upon possession. I'm going to assume that the 320,000 is going to be paid in the very last month, because that is when we are going to be possessing the property. Now, this one last column that I've introduced myself is this column C, which basically shows how much is it that you would be paying if you had the cash, which, as we know, with a 10% discount is going to amount to just 90% of the amount that is stated in the payment plan. And so for a 10 marlas plot, you would need a total of 3.06 million rupees. So now think about this situation in the following sense. Let's suppose you go to the sales office and you give 680,000 rupees to the sales guy that you're talking to. Say, okay, here's 680,000 rupees. Okay, so that's taken care of right there and then. Now the sales guy says, look, if you have the funds then today, then the house costs a total of 3.06 million, which means that if you've paid us 680,000 rupees, you just need to pay us the difference between 3.06 and 680 and be done with it, right? So this is the extra amount. So basically all you need to do is give us 2.38 million rupees right now and you're done. The property is yours. Unfortunately, if you're like most people, you're like, man, I don't have these kind of funds lying around, in which case the guy says, okay, then I'll happily take your $680,000. We'll consider that as a down payment. And now please come back at the end of the first month, give us 50,000 rupees, come at the end of the second month. In fact, give us a payment of 50,000 rupees till the end of 48 months, or every month for the next 48 months. So this is what this timeline is showing. And then at the very last month, please, in addition to this 50,000, please make a payment of 320,000 rupees to possess the property as well. And so what I'm showing to you is this. Effectively, you are borrowing 2.38 million rupees today. And for that, you are making a payment of $50,000 every month for the next 48 months. And then you're finally going to make a payment of 320,000 rupees as well. If somebody asks you what is effectively the monthly rate that you are paying on borrowing this amount, then this actually is a simple application of this rate function in Excel, which I've discussed in a separate video altogether. So I'm not going to bore you with that. But if you make use of this rate function, in which this is the amount that you're borrowing, these are the payments that you're making, 50,000, and this is the future value, or the one lump sum payment that you're going to make in the future, it turns out that the monthly rate of borrowing is at about 0.50%. You can convert this into an APR by just multiplying it by 12, right? Because this is the monthly rate. You can just multiply it by 12 to get what you're paying on an annual basis. And effective annual rate is basically how much you're paying after accounting for the fact that this is getting compounded. This interest rate is getting compounded on a monthly basis. And so what I'm saying to you is that essentially you are borrowing 2.38 million rupees on which you're paying an interest rate of 6.02% or an effective annual rate of 6.19%. What I've done here is that I have then done the similar calculation for all these residential and commercial plots. And the picture that emerges is an interesting one. The one thing that is clear, at least based on this payment plan, is that if you buy a residential plot versus a commercial plot, then keeping the size the same, it turns out that you are paying more of an interest on commercial properties than on residential. So for example, if you take a look at the residential 8 marlas plot, the APR that you're paying on that is about 6.05%, whereas it's a little bit higher on a commercial property, 6.11%. If you take a look at 4 marlas commercial versus 4 marlas residential, the difference is even higher. You're paying a relatively low rate of 5.89% on residential compared to 6.11%. But other than that, it seems like within residential, it doesn't seem like there is a correlation between plot size and APR. So for example, you're paying 6.02% on a 10 marla property, but then if it is a smaller property, you're paying a slightly higher rate. But then if it becomes a little bit smaller further, now the rate that you're paying is a little bit lower, 5.98. As the property size goes down further, you're paying a higher rate, then a lower rate further, then a lower rate further. So it doesn't seem like there is a strong connection between the size of the property and the rate that you're paying on it. Nonetheless, it seems that the rate that you're paying on commercial properties is higher than that on residential properties. The main point of this exercise is this: when there is an upfront discount that you're getting on a cash payment, but you are unable to avail that discount because you don't have the funds, then technically you are borrowing money, and which means that, well, like it or not, you are paying interest. The reason why this is important is because sometimes people have this misperception that if there is a payment plan and the total amount is just being spread out evenly over time, that they're not being charged any interest. And what I'm trying to tell you is that as long as there is a discount that is being offered on an upfront payment, like it or not, you are paying an interest.